All right, let's dive deep into this whole idea of building wealth that lasts,
Yeah.
kind of wealth that keeps growing over time.
Yeah.
And that's where value investing and the power of compounding come in.
Interesting.
We've got all these awesome sources lined up,
Yeah.
classic investment wisdom, stories of people who've actually made it big.
Right.
And we're even going to tap into some psychology to get inside the heads of the masters like Warren Buffett and Charlie Munger.
I like it.
So get ready to unlock the secrets to long-term financial success.
Let's do it.
Okay, so to kick things off, we got to go back to the foundation of value investing.
Okay.
And you can't talk about that without mentioning Security Analysis by Benjamin Graham and David Dodd.
Ah, the Bible.
Exactly. It's like the Investor's Bible.
Right, totally.
What really jumped out at me was their focus on a company's future earnings potential. It's not just about looking at what they did yesterday. It's about understanding what they're capable of tomorrow.
Right, you got to see the potential.
Yeah, exactly.
It's all about understanding a company's intrinsic value, what it's really worth, regardless of all this stock market craziness.
So it's kind of like seeing past the noise and hype.
Precisely.
Sort of like when you buy a bond, you're focused on those future interest payments, the coupons.
Yeah.
And get this, Buffett had a similar thought. Back in '77, in a Fortune article, he even called a company's equity coupon its owner earnings.
Interesting.
It's like the cash a company can actually generate for its owners, the real deal.
Makes sense.
So it's those owner earnings that we need to zero in on to figure out a company's true value.
And here's where it gets even more interesting.
Okay, I'm listening.
When a company decides to hold back some earnings, instead of paying everything out as dividends, those earnings get reinvested, and that fuels the company's growth.
Ah, I see.
And as an investor, you get to ride that wave of growth.
So it's like owning a piece of a money-making machine that's getting bigger and better.
Exactly. You're participating in that productive power.
But here's the thing. It's not just about crunching numbers, right?
Right.
You could have a company with amazing financials, but terrible management.
Oh, for sure.
That's where things get tricky.
Absolutely.
And that's why we got to look beyond just the numbers, dig a little deeper.
I agree.
So have you ever heard of the Rittenhouse rankings?
Rittenhouse rankings? No. Can't say I have.
So they analyze shareholder letters, but they're looking for things like jargon and cliches.
That's interesting. I wonder why.
Well, think about it.
Okay.
If you're reading a shareholder letter and it's full of fluff and vague language, it could be a sign that management isn't being straight up,
Hiding something.
Yeah, exactly. And that raises red flags about their integrity, wouldn't you say?
Oh, absolutely.
It reminds me of when Warren Buffett decided to shut down his investment partnership back in '69.
What happened?
He felt like he was running out of good investment ideas and didn't want to risk his partner's money.
Wow. That's a powerful statement.
Talk about putting integrity above everything else.
No kidding. That's putting your money where your mouth is.
Right. And I think it really highlights the importance of finding companies run by people you can actually trust.
You got to have that trust, yeah.
And if a legend like Warren Buffett can admit to running out of good ideas.
That's humbling.
It tells us a lot about the need for patience and being super picky in our own investing journey.
Patience is key, for sure.
You got it. And speaking of patience and being selective,
Okay.
there's this really interesting story in our research about a senior investor who actually tipped someone off about a potential fraud.
Oh, wow.
Yeah, in one of their portfolio companies.
That's incredible.
And it just goes to show how important building relationships and goodwill is in the investment world.
It's not just about the numbers then.
Right. Sometimes those connections can give you invaluable insights and even save you from making big, costly mistakes.
Like a safety net almost.
Exactly. So before we jump into the next part,
Okay.
let's talk about playing the long game.
Okay.
This is where the power of compounding really shines.
I'm intrigued.
And the joys of compounding, there's this awesome quote. It says, people who arbitrage time will almost always outperform.
Arbitrage time. I like that.
Yeah, it really highlights the power of delayed gratification, something we often forget in today's world where everything moves so fast.
It's true. We want everything now.
Exactly.
It's tough, though, waiting for those results.
Yeah, it takes discipline.
For sure. But it's worth it in the end.
Absolutely. And nobody demonstrates that better than Warren Buffett and Charlie Munger.
Legends.
Their ability to hold investments for years, even decades, it's incredible.
They're playing the long game, really letting that compounding work its magic.
Exactly. And it's paid off big time for them.
No doubt about it.
Speaking of long-term returns, we got to talk about the Nifty 50 stocks.
Oh, yeah, those are interesting.
They were considered crazy expensive back in the 70s.
Like the darlings of the market, but with a hefty price tag.
But guess what? Many of those companies ended up performing amazingly well over the next few decades.
It's like everyone underestimated their staying power.
It makes you wonder if some of the companies that seem pricey today will be the superstars of tomorrow.
That's the challenge, right? Identifying those long-term winners.
But like our sources emphasize, risk is always part of the equation.
Always got to keep that in mind.
Even the best companies can stumble.
Absolutely. No investment is foolproof.
That's where the concept of a margin of safety comes into play.
Ah, that buffer, that cushion.
Buying stocks at a discount, it gives you some protection against those inevitable market swings.
Like having a little insurance policy.
Exactly. So imagine you've done your homework, you've found a company you believe in, and you're ready to invest.
Okay, I'm with you.
But before you go all in, we got to remember that the market can be a wild ride.
For sure, it's not always predictable.
Everyone says the market is always right, but even Warren Buffett knows it's not that simple.
Yeah, he's seen it all.
He famously said the market is efficient most, but not all of the time.
There are those moments when things get a little irrational.
Exactly. And one of those areas where the market can get things wrong is with bubbles.
Oh, the bubbles. Those can be dangerous.
Think about the dot-com frenzy. Everyone got caught up in the hype.
It was like a gold rush.
People were throwing money at anything with a dot-com in its name, convinced they were going to strike it rich.
The fear of missing out was real.
And all the traditional valuation metrics, they went out the window.
Yeah, it was like a collective delusion.
But bubbles eventually burst, and that can be brutal for those who got caught up in the frenzy.
It's a hard lesson to learn.
So what are some signs of a bubble? Things to watch out for?
Well, you usually see a lot of euphoria, excessive leverage, and people ignoring those fundamental valuation metrics.
They get swept up in the excitement.
And then there's that dangerous narrative. This time it's different.
The famous last words.
Right. And of course, you can't forget about those black swan events.
Those unpredictable events that can shake things up.
Like the 2008 financial crisis or the COVID-19 pandemic.
Those were definitely wake-up calls.
They remind us that no matter how much we plan, there are always unforeseen circumstances.
And that's why diversification is so important.
Spreading your investments, not putting all your eggs in one basket.
It helps reduce the impact of any single event on your portfolio.
Exactly. It's all about managing that risk.
But diversification is just one piece of the puzzle.
Right. There's more to it.
Our sources also talk about the importance of always learning and adapting to a market that's constantly changing.
It's a dynamic landscape.
That's where the concept of Bayesian thinking comes in.
Updating our beliefs as we get new information.
It helps us challenge our assumptions and make more rational decisions.
It's like constantly refining your mental models.
And this ties back to those turnaround situations.
Companies that were struggling but then find a way to turn things around.
Sometimes investors miss out on those opportunities because they're stuck in the past.
They get anchored to that old narrative.
It's like thinking, this company has always had problems, so it always will.
But things change, right?
Exactly. New management, new products, even a shift in the industry can transform a company.
It's like a phoenix rising from the ashes.
So it's important to be open to reevaluating our opinions and looking for those hidden gems that others might be overlooking. So it sounds like we need to balance staying informed with being flexible.
Yeah.
Ready to adapt when things change.
Exactly. It's like walking a tightrope sometimes.
But let's say we've done all the research, we've found these amazing companies, we're ready to invest.
Okay, the exciting part.
What's next? How do we manage all these investments?
That's where portfolio construction comes in, figuring out how much of your money to put in each investment.
Right, like creating a balanced meal.
Exactly. You need different ingredients to make sure you're getting all the nutrients.
So in investing, that means diversifying, spreading your risk around.
Precisely. Not putting all your eggs in one basket.
But there's always this debate about how much diversification is enough.
Yeah, it's a tricky balance.
I mean, we hear about investors like Warren Buffett who put a lot of their money in just a few companies.
Right, concentrated bets.
So how do we reconcile that with the whole idea of spreading risk?
Well, diversification is important, but spreading yourself too thin can actually hurt you.
How so?
Think about it. If you own hundreds of stocks, it's almost impossible to really understand and track each company.
It becomes overwhelming.
Exactly. You lose that focus.
So it's about finding that sweet spot, right?
Right. Focus on depth over breadth.
Meaning?
Really dig deep into the companies you're considering.
Do your homework.
If you understand a business inside and out, its long-term prospects,
Yeah.
you'll be more comfortable putting a larger chunk of your money there.
It goes back to that saying, invest in what you know.
Exactly. And the more confident you are in your analysis,
Yeah.
the less you have to rely on diversification as a safety net.
It's like having that extra layer of conviction.
And it's fascinating. Some research actually suggests that for individual investors,
Okay, tell me more.
owning more than 20 different stocks might be a sign of financial incompetence.
Wow. That's a bold statement.
It's a bit provocative, right?
Definitely makes you think.
But it highlights that quality is more important than quantity when it comes to building a winning portfolio.
So be thoughtful, be intentional about your choices.
Exactly. Don't diversify just for the sake of it.
Make sure each investment has a purpose in your overall strategy.
Absolutely. Now, here's something we often forget to factor in.
What's that?
Luck.
Ah, the wild card.
Even the best investors get lucky sometimes, and sometimes they get unlucky.
So how do we deal with that unpredictable element?
Well, over the long term, skill and discipline tend to win out.
Makes sense.
The key is to have a solid investment process and stick with it even when luck isn't on your side.
Ride out those storms.
Exactly. Remember, investing is a marathon, not a sprint.
So for our listeners who are just starting their investing journey, what's the one thing they should take away from all of this?
I'd say the most important thing is that value investing is more than just a set of rules.
Yeah.
It's a philosophy, a way of thinking about businesses, about the long term, and having the discipline to stay the course, even when things get bumpy.
Sounds like it's about more than just making money.
It is. It's about building a solid foundation for a better future.
Well said. And with that, I think it's time to wrap up our deep dive into value investing and the power of compounding.
It's been a great conversation.
Absolutely. Thanks for joining us on this journey. I hope you've gained some valuable insights that will help you on your path to financial success.
And remember, keep learning, keep exploring, and keep investing in your future.
Until next time.